Welcome to Dollars and Dwellings. I'm Patrick Diamond.
And I'm Ralph DiBugnara. Welcome to our podcast.
Welcome back to the Dollars and Dwellings podcast. I'm Ralph DiBugnara with Patrick Diamond, and we're here for episode 6, I think, Pat, right? We're only up to 6 episodes?
That might be right. It's either 6 or 7.
Okay, we're getting there, though. We're doing better.
This one, obviously, we have a little different format today.
We're recording virtually today. We're usually in person, but we're going to give you the same great content. There's a lot of stuff going on in the market right now, so we're going to give you a little bit of a market update too. And I think the thing that I saw first and foremost was last Friday, and we're in the second week of November right now. The non-farm payroll came out, and it's relevant because it came down for the first time in a long time, which has a huge impact on interest rates.
Yeah, it came down. I mean, I was going to ask you what you were seeing in sort of on your. I know we talked about rate sheets on an earlier episode. I was going to ask you what you were seeing on rate sheets. To your point, because rates there's a lot of volatility in the rate market right now, and it's affecting a lot of things from the stock market to mortgage rates.
I mean, it was a big deal. Friday was probably the largest move we've had in a positive manner in, I don't know, 2 quarters, right? And we had a huge shift. Today, it opened down where rates were down some, and then we lost a little bit. But overall, it's been a big shift in a different direction. And, reading kind of what the market is thinking, I believe that they see the Fed, which I think was happening anyway, pausing rate hikes from here on out, at least for the immediate future.
Yeah.
And then, I mean, I don't know what you think about the first quarter of next year, but I don't know do you think it's going to come down?
Yeah, it's fine. I was going to say it's hard to not be like a nerd on interest rates right now, given where you work and where I work. I mean, like it's the 10-year, it's the yield on the 10-year Treasury that sort of everybody's watching right now, right? Because that jumped a lot in the last, I'd say month or so, up to like 5%. But then last week, to your point, we started pull back almost just about 40 basis points in just like,
huge,
like a week and a half. That's, unless you follow interest rates, you wouldn't appreciate that, but it's really a huge move in interest rates in not a lot of time. I mean, I go back and I think we talked about it in a previous episode. There's a statistic that the longest the Fed has held rates before they lower them is 9 months. And I think we talked about that at the time. That would take us to May or June 2024, just using that 9-month figure. But, that's a historical statistic.
Yeah, but I actually agree with that. I can't see them opening the year by cutting interest rates. I really can't. I think that I personally feel like you won't see it till late first quarter, early second quarter at earliest. Mm-hmm. Before they start lowering rates. And, just for the general public, I believe if they do start lowering the Fed borrowing rate, that, you'll see rates back in the 6s. I think last week was it Goldman, I believe, that released their forecast for 2024. Goldman Sachs released their forecast for 2024. And I believe that they foresaw rates averaging in the 7s, around 7.5 for 2024. And I don't know if I necessarily agree with that. It may be not too far off, but I believe low 7s is realistic for next year for an average.
Yeah. Are you seeing any difference between fixed rates and ARMs at the moment?
ARM pricing is actually starting to improve. It wasn't for a long time. For a long time, it was very, very close to the 30-year fixed pricing for adjustable rate mortgages. Now we're starting to see some significant improvement on it, which I believe is a positive sign for the market. For good or bad, it means that there's some stabilization in the market and they feel comfortable giving out ARMs again. Mm-hmm. And again, for beginners, as far as an ARM compared to a fixed, usually you have a significantly lower rate for an adjustable rate mortgage, which is only fixed for a certain amount of time, 3, 5, 7, or 10 years. But for a long time, it was close. But now I actually see the pricing has come down a lot over the last couple of weeks, which tells you that the market feels at least stable, and they feel comfortable giving out those lower rates.
Yeah, I think it was either episode 1 or episode 2 when we kind of did a deep dive into mortgages. We sort of touched on the fact that ARM pricing was generally you can get a better deal on an ARM, but because of the weird world we were living in, ARMs and fixed rates were were pretty close, and there wasn't a lot of advantage to taking out an arm. But that's interesting that you're seeing the market move a
Yeah,
little bit.
there's a big difference again, which again I think is a good thing. The biggest problem you're going to have right now is that it's very, very hard for Wall Street to determine where rates are going. And believe me, they don't know, because if they knew, you wouldn't see such drastic movements in the market. It would really be more, the gaps would be closer together when there actually is movement. Here's something that nobody's talking about, and this isn't necessarily what this episode is about, but I think it's relevant. If there is,
This episode's pretty free range.
yeah, but what the Fed is going to avoid doing, in my opinion, is any kind of drastic rate shift. Because let's say if rates went from what they were last week, which was in the 8s, until the 6s or the 5s, what will happen then is all the banks that lent money over the last year and a half at the higher rates, there will be a run on to refinance.
Mm-hmm.
And if that happens, it could really make a lot of banks insolvent, because they count on holding these mortgages for a certain period of time. And it's also collateral for them. So if they lose all these mortgages that they're collecting interest rates on, there also could be penalties on those loans for the banks if they're paid off super early. So I think the Fed has to be cautious about how fast these rates come down, because if they're not, you could create a significant issue in the banking industry as far as banks not have the capital to keep up with what's going on around them.
Yeah, I mean, I know we saw the distress in sort of the regional banks earlier in the year, and that was because rates were moving up too quickly.
Yep.
But that's interesting what you said.
Anything drastic, like a
Yeah,
company Chase can handle. They have a huge portfolio, but some of the smaller lenders, and the benefit of a smaller lender to a customer is that they make the market more competitive. And by making the market more competitive, the consumer ultimately gets a better rate. But they can also not handle a huge kind of runoff of their book of business. And if that happens, because trust me, Pat, all these mortgage people are vultures, and they're waiting for rates to drop so they can attack each other's book of business.
mm-hmm.
I'm going to try to refinance every single loan I possibly can. I don't care who owns it and who has it. I'm going to refinance all those loans. So, I think that it won't. For that reason, I think you won't see it come down very fast. It'll take some time for it to come down slowly.
Yeah. I mean, for us here, in my firm, all eyes are on, and it's not just us. I think it's economists and the finance world in general. Sort of all eyes are on the employment numbers. To your point, when you mentioned to start the episode, jobs numbers for October came in soft versus for September, it was the Fed had their press conference on Wednesday. The jobs number came out on Friday, and that's when we saw some craziness in the interest rate market and the stock market. So
yeah, and for the general public, like, just look around you, and I'm seeing it for sure. I'm seeing it in my business, my mortgage business. I'm seeing it in my Airbnb business. I'm seeing it in local gyms, and everything is, people are spending less money. Like, I feel it personally, and I'm seeing it personally out there, that there's less and less free spending of money right now, which tells you that. And by the way, all the numbers are always a month behind, or 60 days behind, or 90 days behind. So what could be happening already since September, we're just kind of finding out in November. So, but I personally, I don't know how you feel. I personally feel like I'm feeling it in almost all aspects of my life, where I'm seeing things slow down.
Well, I'll tell you the one place I don't see it slowing down, which is home renovations. Because like when I drive around like my town and the whole state of Rhode Island, it's crazy how much construction is still going on, especially, home renovation and home rebuilding. And I hope we can do an episode on sort of home renovation at some point, because I'm hoping to do a big renovation on my house, but I'm terrified to have the conversation with the builders, because they're going to be like, yeah, get on the list, man. We'll see you in like 2026.
Yeah, and for better or worse, that's the only way you're going to dig out of this problem is building of homes. And the other thing that's coming, it's funny you mentioned that this it came out, I think 2 weeks ago, that the Biden administration just okayed it was a big number. I don't quote me on this. It was somewhere between $3 and $5 billion to real estate, as far as giving people more money for renovation money. Renovation to build new homes and to rehab new homes. The bill that came in 2 weeks ago, and I'll find it. But that is something that, because I think they realize what everybody else realizes, that you can't dig out of this without having something that ultimately puts money into the. Yeah, I'm sorry.
You
It
looking at?
was a bunch of things. It was climate. It was a bunch of things. The Biden and Harris, and they announced it last week that they're going to be funding more of these projects.
Oh,
The
part of
reason,
like the infrastructure spending bill,
correct. Yeah,
probably. Yeah.
yeah, it's exactly what it was.
Yeah,
Um,
yeah. I mean, they've already released a lot of there's a lot of home energy efficiency tax credits and rebates. Um, but yeah, no, that'll be interesting if there's funds set aside for
yeah,
specifically for renovations in
I don't
addition
know.
to energy
And I don't know
efficiency.
if we've talked since this. I don't think we have, but I put one of my properties up in Florida for sale, because again, the Airbnb market down there has gotten very, very slow. And where the property is located, it made a lot more sense for me to sell it currently. But being from the Northeast, I really was in the mindset that I'll put it up, I'll put it for a reasonable price. It's going to fly. I'll have bidding wars, all that kind of stuff. And it hasn't been that experience. I am in contract right now for asking price, but
Hmm.
it took 3 or 4 weeks, maybe 4, and I had a lot of low offers, and I had a lot of people like kind of kicking tires, and I was really surprised, to be honest with you, that it wasn't more, that it took so much when you get a full ask offer. And I by no means, I listed the property for 425,000. There were comps as high as 470,000, so I was really realistic with the price. But it shows you that other markets are softening a little bit because of the high interest rates.
Yeah, I mean, I certainly had a client who had a home appraised recently, and then decided to put it on the market and got some quotes from real estate agents. This is in Naples, Florida.
Okay.
Um, yeah, and the quotes from the real estate agents came in well below the appraised value of a couple months ago. So
Yeah, I imagine that's probably, there's a luxury market there. I don't know if that's where he was leasing, renting. I mean, not selling, but the luxury market for sure stuff is sitting right now. And what I mean by luxury, anything over 2 million, that
yeah,
seems to
no,
be the number right now. 2 million.
this house is around like 600,000.
Okay, so that's surprising. But yeah, Florida. I think Florida right now, in states where they can still build, and where I'm selling this property in Ocala, Florida, they're building all over the place. So I think in states where they can still build, then now there's inventory. So it's not a bad real estate market. It's just a normal real estate market. It's not an
Yeah.
inflated real estate market.
Oh, hey, by the way, did you see this headline about the National Association of Realtors verdict, where
Yeah,
like
yeah.
apparently real estate agents can't charge
I've
a
heard
six
about it.
percent fee
I've
moving
heard about
forward?
it. I believe that they're obviously going to appeal. I think the final verdict of that will be somewhere in between, because I don't believe that you can eliminate the buyer's agent. And just for everybody's the sake of this conversation, is there's a buyer and a seller agent on each transaction. Usually, the seller's agent sets the commission for the transaction, but then they split that commission with the buyer's agent most of the time. That's pretty standard. Or it's set forth on the contract that the seller's agent's getting 3 and the buyer's agent's getting 2, but some variation of that. Through this lawsuit, if it goes through the way it is and they change the laws, it would essentially eliminate the need for a buyer's agent, because what they're saying is that the buyer is going to have to pay their agent themselves.
Hmm.
If they force them to do that, there's no reason for the buyer not to go directly to the seller's agent and just eliminate the buyer's agent completely, which would take out hundreds of thousands of jobs in this market, which I don't think is the goal of this exercise. So it's definitely groundbreaking that they and literally the next day, that same law firm filed suits against every other major real estate company,
Yeah.
Compass, Redfin, everybody. So they won. Remax settled before the case went to court, and then Keller Williams lost in court. So it's interesting. I don't know what's going to come of it, but I think it's probably
Yeah.
somewhere in the middle.
Yeah, I mean, my experience with real estate brokers is more on the rental side, um, and I've always thought it was a funny thing there, right? Because sometimes a, a broker, sometimes they don't do any work, right? Like you look at an apartment once and you're like, yeah, I'll take it.
Yeah.
Other times they're showing you apartments for like weeks and weeks, and okay, then they've certainly worked hard, and
1,000%. Yeah. Yeah.
so
Yeah.
I
Their
mean,
job is, you're right. Sometimes it's very, very easy. Sometimes it's very, very hard. But I don't know. I don't see it standing as is, Patty. I really don't think it can. It
yeah.
can. I think they're doing it. The reason they did it was for good reason. They felt like there was collusion between the sellers and buyers agent. In these cases, there was that the sellers were being charged higher fees based off of everybody getting together and saying, "Hey, let's make the market this." So that's not good either. But
yeah.
At the same time, I think that you need something to keep the market balanced.
Yeah. Hey, the other interesting statistic I came across last week that I haven't been able to independently verify is relating to U.S. mortgages that are delinquent by 90 days or more, right? Which, correct me if I'm wrong, but that's considered like a major delinquency, 90 days or more. So like 3 months late on a mortgage payment. The statistic I heard was that 90-day or more delinquencies are the lowest since going back to like 1999. But again, I haven't been able to independently verify that statistic, but it's an interesting statistic, meaning it's the idea of, even though rates have risen, most people have locked in that low rate and they haven't really felt the pain of increased interest rates, at least on their mortgages.
No, you're 100% right. I think for the last year, I think you're 1,000% right on that number. It's been low. What's coming out of that, and what I'm starting to see rumblings about, and there was 2 articles the other day that I read. One, I think I was actually quoted, and it was on Yahoo or Bankrate, one of those, and it was, house rich and cash poor, and that's really a lot of people in this country right now. That they have.
By the way, I used a soundbite of that exact quote on one of my LinkedIn posts. It's got that one quote got the most attention of like any of my posts recently.
Yeah, it's because it's true. It's really, you're starting to see more and more people report it, and in my opinion, and with no experience with this, it's going to cause people to sell. Like people aren't going to suffer financially where they have no money in the bank and they're looking at this equity in their house. They did nothing to gain except live there, and not sell. So, I just don't think you'll see people not sell at this point or refinance or something. They have to access the cash in the house. It's really stupid to sit with high interest rate credit card debt or no money in the bank and have equity in your home and suffer in that manner, depending how long you can withstand that. But that's starting to become a real problem.
Yeah. Well, I guess all of this is to say that it still is a crazy real estate market out there. I mean, I don't want to say that the housing market is broken, but with rates moving up as quickly as they've risen, it just seems like the housing market is a bit dysfunctional at the moment.
Yeah, I can tell you that I get asked to quote on articles like industry publications from time to time, like Realtor.com, Bankrate, Yahoo Finance, USA Today, stuff like that. And I tend to get anywhere between 5 and 7 quotes a month that I get usually asked for on average. I think that's a pretty good average, right? I'm getting 5 to 7 quotes a week now about real estate and what's going on in the market, which tells you what a hot button is. Forget about the industry, and it's such a hot button issue right now because it really is impacting the whole entire country and all of our economy, I believe. And I'm getting asked literally sometimes 2, 3 times a day to quote on articles about what's going on in the market right now. So that's really interesting.
No, I mean, the Wall Street Journal, Bloomberg, the New York Times, every day there's like 2 articles dedicated to the real estate market currently. So it's definitely on everybody's mind still. Which means this was great timing in doing dollars and dwellings.
Yeah, we're jumping in the middle of this to try to give you guys what's going on today. And we, as you can see, and Pat and I, we actually read on this stuff every once in a while because we can have a conversation about it without really preempting this podcast.
Yeah. But I think this is a good market update. You want to wrap it up here and we'll kind of, 100%. All right. Sounds good.
All right, guys.
Well, thanks. Yeah. Thanks everybody. Patrick Diamond.
For Ralph McNair. We'll see you guys soon.
Yeah. We'll talk to you soon. Bye. This is your co-host, Patrick Diamond. I'm a vice president and certified financial planner with Wealth Management Resources in Smithfield, Rhode Island, where I serve our investment customers as an investment advisor representative. My co-host is Ralph DiBagnera. Ralph serves as president of Home Qualified, the digital resource for buyers, sellers, and real estate agents. He's also vice president at Cardinal Financial, a nationally recognized mortgage loan company, and he's the recent author of The Growth Trap, a continuous plan to avoid the traps of life and build a better you. Our discussion is not tied to the offer or sale of any investment products or products in general. This podcast is for informational purposes only and is not meant to be legal, tax, or investment advice.